Crypto is collapsing. Bitcoin lost all the supports that we were looking for, and we are now at 104k with the potential to actually go even lower to the 98k level. Everyone is talking about bear market, everyone is so bearish, but there is one thing which I want to share with you, and that's the link between liquidity and crypto, which is very important and which drives the whole crypto game. So I'll show you this chart here. It has two lines. The black line is the GMI US total liquidity, basically how much money or liquidity is circulating through the US financial system. And the pink line or the red line that you see over here, this is the total crypto market cap excluding Bitcoin. That's all the altcoins combined together. Now, if you look at those two lines, they are related, they're synced. When liquidity goes up, crypto goes up. When liquidity drops, crypto falls. And that's not a coincidence at all. Liquidity is like oxygen for the markets. When there is more cash in the system, whether it's from government spending, central banks' actions, or bank reserves, people have more money to invest. And where does that money go? It goes into riskier, high return assets like stocks, tech, and of course, crypto. So the first big takeaway here is that crypto doesn't move in isolation. It moves with liquidity, and liquidity is the main driver for the crypto prices. Why crypto is going down right now? If liquidity drives crypto. Liquidity has been recovering, so why hasn't Toto2, the altcoin market, broken to new highs yet for most of the altcoins? Well, here is why, because the liquidity cycle got very delayed this time. The US government recently faced a shutdown, and if I'm not wrong here, it's been shut down now for 34 days, which is a very long time. So with this shutdown, basically, the Treasury General Account, or the so-called TGA, which is basically the government's checking account, slowed down spending dramatically. So that spending paused temporarily, and that reduced liquidity flowing into the system. So less liquidity means obviously slower markets. But here is the key point, that money isn't gone, it's just paused, waiting to be released once the government fully reopens and resumes normal operations. So this is what most of us are missing here, the liquidity part, which is not gone. It's actually paused because of the government shutdown. And what we're seeing right now is not a collapse, it's a delay in the next wave of liquidity. And now let's talk about something that I learned from other macro investors, the everything code. This refers to how debt gets monetized. So when governments spend more than they earn, they issue debt, the treasury bonds. But over time, as interest payments rise and debts pile up, central banks eventually have to step in to keep the system running smoothly. How they do that? They do that by creating new liquidity. In other words, more money into the system, which eventually finds its way into the financial markets. And this process, turning debt into money, is what's called monetizing the debt. And here is the interesting part. And because much of the US debt has now been extended to around 5 years, the largest liquidity wave tied to that debt hasn't entered or hasn't hit the system yet. That means the biggest part of the liquidity cycle, the part that truly fuels risk assets, is still ahead of us. So while a lot of other people and experts are calling the bear market, I still think that the last few months felt very quiet, and the setup for the next big liquidity push is being built right now. And that's probably coming with resuming the operations for the US government. And the liquidity flood is coming, and I'll show you this second chart, which is getting a little bit more interesting. This second chart compares US total liquidity again in black, but this time against the federal government interest payments shown by the pink or the red line. And if you look at the top, you would see the red legend, it says 36-month late. That means interest payments, what the government pays on its debt, tend to lead liquidity by about 3 years. And as you can see, those interest payments are skyrocketing right now. So what does this imply? If you think about it, it means that the system will likely need to create more liquidity over the next few years to handle those rising debt costs. In other words, we are setting up for what's called a liquidity flood, a big surge of money entering the system from multiple sources. So it's not purely, technical analysis, it's not purely news, it's a combination of macro elements with chart analysis, with overall market sentiment. And mainly liquidity, because this is what's driving the crypto space. And as I said, money will be entering the system from multiple sources, and those sources are the TGA, the Treasury General Account. Once government fully reopens and starts spending again, the money flows out into the economy, adding liquidity. Also, the People's Bank of China, China's central bank, has also been expanding its balance sheet, which contributes to global liquidity, especially since global markets are interconnected. Then you also have the bank reserves. When banks rebuild their reserves, it means they're holding more cash, and that often reflects looser monetary conditions. And we expect another interest rate cut in December as well, which is not yet confirmed, but it's something that is still on the table as an option. So, if we put all of that together, you get what the macro analysts call a multi-vector liquidity injection, meaning liquidity is entering the system from several directions at once, and this is what pushes the altcoins up. But again, this will take time. It's not something that happens overnight. It's not overnight change. Liquidity waves build gradually, and once they begin, they tend to last for a couple of months to even years. That's why patience is key. A lot of traders try to time every short term move, but macro investors understand that the big money is made by catching the liquidity cycle itself. When liquidity expands, risk assets rise. When liquidity contracts, they fall. And in upcoming months, we're going to see more expansion.